Have you ever wondered how a global insurer resets after a billion-dollar hit? Everest Group is making bold moves to redefine its future in 2025. Everest Group Limited is a Bermuda-based global reinsurer and insurer. It operates through reinsurance and insurance segments, with selective accident and health and some life capabilities. The year 2025 marks a reset under new CEO Jim Williamson. Reinsurance is the core focus, historically making up over 70% of gross written premiums. Key strengths include property catastrophe XOL, property pro rata, non-cat XOL, and financial lines like mortgage and credit. Insurance is the growth engine, especially in accident and health, notably medical stop-loss, as well as specialty casualty, professional liability such as D&O, E&O, and cyber, and property or short-tail lines. Everest also manages over $30 billion in high-quality fixed-income investments, with alternatives making up 10 to 15% for added alpha. The company earns premiums from reinsurance and insurance products. It generates strong net investment income, especially in a higher-for-longer rate environment, about $540 million in the third quarter of 2025. Everest diversifies returns through alternatives and macro-linked financial lines. Why does this matter now? The year 2025 is a turning point. There was a $1.5 billion reserve strengthening in the fourth quarter of 2024, and U.S. casualty is under pressure from social inflation. The insurance segment's third quarter 2025 combined ratio at 138.1% signals remediation needs. On October 27, 2025, Everest announced an adverse development cover with Longtail Re, providing up to $1.2 billion of protection for legacy North American insurance risks. The company also sold renewal rights for underperforming retail commercial lines to refocus on advantaged reinsurance and high-margin specialty insurance. What could go right? Reinsurance remains a cornerstone, leveraging hard market pricing and advanced catastrophe models. Mount Logan Re brings in third-party capital. Accident and health and property or short-tail lines show strong, less volatile performance. Digital, data, and AI initiatives aim to boost underwriting precision and efficiency. Management targets mid-teens total shareholder return and a normalized combined ratio of 90 to 93% by 2026. What could go wrong? U.S. casualty remains pressured by social inflation and legacy claims. The insurance segment's high combined ratio signals ongoing challenges. There is execution risk in shifting the portfolio and digital transformation. Competition is intense from global giants like Munich Re, Swiss Re, Chubb, and Travelers. Everest Group is decisively addressing legacy risks and refocusing on its strengths. If management delivers, expect improved profitability, strong returns, and a more resilient business model by 2026. For investors, this is a story of disciplined reset and potential upside, worth a closer look.